Hi, folks. Welcome back to the weekly market and value aligned portfolio review for the week ending August 16th, 2025. I'm David Berkowitz. In today's breakdown, we're going to cover what drove the markets this week, the big winners and losers in both the S&P 500 and our value aligned portfolio, and the critical catalysts coming up that every investor needs to watch. If wealth is your goal, you need clarity, not noise. Let's get right into it. This week was a tale of two forces colliding. On one hand, Wall Street is celebrating with more than a 90% probability priced in for a September Fed rate cut. That drove the Nasdaq to new record highs and boosted small caps. On the other hand, the Trump administration dropped a bombshell: 100% tariffs on imported semiconductors. Add to that a hotter than expected producer price index, and you've got markets rallying on rate cut optimism while ignoring inflationary policies that could force the Fed to rethink. This is an opinion, it's math, and that's why the foundation for this rally is fragile. Indexes told the story of risk-on appetite. The Nasdaq not only erased last week's losses, but pushed into record territory. The Russell 2000, the most rate-sensitive index, jumped more than 2% as small caps benefit the most when borrowing costs come down. The S&P 500 and Dow also finished higher, but with more measured gains, reflecting that under the surface, there's turbulence. Small caps led with a 2.31% gain on the week. That's a classic sign investors are betting the Fed's going to ease. These companies are most sensitive to rates because they rely heavily on debt. But don't confuse a tactical rally with a fundamental shift. The underlying economy is still flashing caution. Beneath the surface, sector divergence was striking. Healthcare surged, up more than 4.6%, thanks in large part to Buffett's big bet on UnitedHealth. Meanwhile, technology lagged, dragged down by semiconductors. Defensive areas like utilities and staples sold off, a rotation that shows investors leaving safety for speculation. That's what happens when Wall Street gets high on rate cut hopes. The biggest winner? Healthcare. Berkshire Hathaway disclosed a significant stake in UnitedHealth, and that Buffett bounce lifted the entire managed care group. But look at semis. Applied Materials guided cautiously, and then tariffs slammed the sector. The result? Tech finished in the red despite record highs in the Nasdaq. That's the split personality economy we've been talking about. Top gainers tell the story. UnitedHealth up a massive 22%, the Buffett effect. First Solar and Enphase Energy rode a wave of clean energy optimism after Sunrun's strong report. This wasn't about broad-based economic strength. It was stock-specific catalysts, investor psychology, and a few bold bets. The losers list was semiconductor heavy. Applied Materials fell 14%, KLA down 8%, LAM Research off 7%. Guidance spooked the sector, and tariffs made it worse. Cisco also dropped after earnings and a downgrade, plus job cut headlines. This shows how vulnerable semis and tech are to both macro and policy shocks. Here's the Fed's problem. The market wants an insurance cut to support the labor market, but tariffs are explicitly inflationary. You can't cut rates to fight weakness and simultaneously deal with cost-push inflation. That's why Powell's team faces one of the most brutal balancing acts since the early 1980s. July CPI came in tame, 2.7% year over year, up slightly from 2.4%. But the PPI? That's where the trouble is. Producer prices spiked 0.9% in a month, the fastest in 3 years. That's a pipeline of inflation waiting to hit consumers. Businesses can only absorb so much before they pass it along. That's what makes this so dangerous. Tariffs have exploded. Average U.S. tariff rates jumped from just 2% at the start of the year to nearly 10%. And semiconductors are ground zero, with a full 100% tariff unless you manufacture in the U.S. That's industrial policy colliding with global supply chains. Short term, it's inflationary. Long term, it may reshape entire industries. Inside the Fed, there's division. Governor Bowman says focus on jobs. Goolsbee and Bostic warned inflation is creeping back. Meanwhile, 10-year Treasury yields ticked up to 4.28%, reflecting market uncertainty. The bond market isn't buying the same story the stock market is celebrating. Now let's turn to the value-aligned portfolio. Our winners and losers this week show precisely where the macro headwinds hit hardest. Top performers came from healthcare and select semis. The laggards? You guessed it. Semiconductors, Cisco, and energy names caught in crosscurrents. This is why ownership and selectivity matter. Eli Lilly surged 12% on 38% revenue growth, raised guidance, and grew its dominance in Incretin drugs. NXP Semiconductors was a standout. While most of the sector sold off, NXPI rose over 10% on strength in automotive and industrial chips. SiriusXM rebounded sharply, supported by Buffett's ownership and big buybacks. Thermo Fisher rose 6% after beating expectations and raising guidance, a clear sign of resilience in life sciences. Bristol Myers gained 5% thanks to an FDA priority review for its CAR-T therapy. This is a reminder, even in turbulent markets, company-specific catalysts drive returns. Cisco fell almost 8% on earnings, job cuts, and a downgrade. Into Parfums slid on weak demand and destocking pressures. Diamondback Energy dipped despite substantial revenue, as earnings just missed by a few cents. Again, not systemic failures, but narratives investors latch onto. Nvidia and Taiwan Semiconductor were both down about 1%, not because of company weakness. Both posted strong fundamentals, but because of sector-wide fear. This is what tariffs and weak guidance from peers can do, drag even the best operators lower. Looking ahead, we've got a packed week. NAHB Housing Index, housing starts, FOMC minutes, PMI data, and the Jackson Hole Symposium. And of course, Powell's Friday speech. That's the big one. If he validates rate cut hopes, markets could soar. If not, brace for turbulence. Here's the setup. Bull case. Fed downplays inflation, calls tariffs a one-time shock, and rate cut odds rise. Bear case. Fed emphasizes tariffs, hints at hawkishness, and smashes market optimism. Beneath the surface, capital is already rotating to defensive sectors like healthcare. That tells you smart money isn't all in on risk. 3 things to watch. 1. Semiconductors. Will companies restructure around tariffs? 2. Healthcare. Does the Buffett bet spark a sustained defensive rotation? 3. Financials and consumer stocks. These will be highly sensitive to Fed signals. That's where next week's story will be written. So that's the week in review and the road ahead. Markets are pricing perfection. A Fed cut in September, but tariffs and inflation may force a reckoning. For us, the lesson is clear. If you want wealth, you need to take action. Own great businesses, stay disciplined, and ignore the noise. This isn't just about surviving volatility. It's about using it to your advantage. Stay the course, and let's talk next week.